FedEx Corporation. This is going to be the fifth company added to our 2023 season valuation ranking. The Sage Seeds AI is going to rank this from either 1 to 5 in terms of value as when this video is coming out. The odds are still very good that you're going to be able to guess the right number. I mean, there's only 5 ranks possible, one being the highest, 5 being the lowest. It's only going to get harder from here. So I say guess while we're going through this. Try to figure out what the ranking is going to be. Let's dive in so that your wisdom can blossom. Opening move is going to be item 8, going to the balance sheet. No marketable securities. Fantastic. What I think is more a normal way to manage your current assets is to not be buying treasuries for the sake of buying treasuries. Now, most of all assets is the warehouses and aircraft and related equipment. Interesting. Planes. It's less than 2-to-1 ratio of assets to liabilities means this company is somewhat in growth mode, is the implication. There are retained earnings and they are pretty average. The company's not building this up very high. It's keeping it at around half of liabilities. Moving on to the statement of income, they don't call out a cost of revenue. Everything is an operating expense. And so, not very usual, but FedEx is thinking that as long as their operating revenue comes, the business is the product. Kind of interesting. It's a very pure service company, which you don't actually see that often. Check out some of the cloud vendor or cloud related company videos. GitLab came out last week, but all the way back to Butterfly Network, where I really for the first time broke down the cloud industry. A lot of these companies are getting slapped on the wrist by auditors for essentially doing something like this, which is that in the cloud services businesses, they're trying to not really use cost of revenue very much in their accounting. That industry is a services industry. Here we have an example of what a pure services industry that is allowed to do this would look like. And it's not that bad, actually. I mean, it makes a lot of sense. And look at how thoughtful the categories of operating expenses are. It's a very informative income statement here. And if cloud companies or cloud related companies could break up their operating expenses more like this, I think they would stop getting slapped on the wrist by auditors, because this is a very mature way to have a statement of income. Most of it is being paid to salaries. Shout out to UPS union if people have seen that in the news. It's a bit of a cutthroat, growth focused industry. If you're in a industry that has a lot of growth happening, you actually don't expect to make a lot of profit. You expect to grow revenue a lot, but for your cost to be increasing almost at the same rate because it's so competitive, right? Growth for an investor, a financial analyst, should signal competition. That's really how you want to think about it. And competition does not correlate to high margin businesses. At the end of the day, their net income margin is about 4-ish%. Does it have to be a high margin when at the end of the day you're collecting 4 billion, 5 billion some years? Maybe not. Moving on to the statement of cash flows, depreciation now is looking more significant. It didn't look so significant in the income statement, but interestingly, it's quite significant in the cash flow statement. It almost doubles the money that is being collected, right? So their net income would be 4 billion, but after adding back the fact that this is a non-cash expense, really they're collecting close to 8 billion or more than 8 billion just with these two line items. Once you take into account the fact that their leases and their deferred income taxes aren't always a cash expense, this is looking like a company that is collecting close to 10 billion in cash a year and then has just working capital management to take care of. And so in the current year of this report, the latest year, their accounts payable was a little bit higher. It was more than 3 billion. But other than that expense, then they're able to invest that further. As long as this continues to be a growth industry, this could be a very good way to spend 6 billion that you are essentially easily able to cover with the already established business. Going back to the income statement, what I just painted is a great picture if we really are in a growth industry. And what we are seeing on the revenue side is a little confusing because in the last year compared to a year prior, revenue actually decreased. But then if you go back to 2 years, 7 billion more than 2 years ago, that's growth. Increasing your revenue by 7 billion is always impressive, regardless of what the growth rate looks like. Billions and billions of dollars of increased revenue should be counted as a growth business. However, there's this little hiccup. Out of this opening move, we want to investigate, is this actually a growth business? Because FedEx here is doing a lot of things that are being managed as if this were a growth business. Pop over to the item one. Hopefully, they're talking about what's been going on with revenue specifically. Over the years, FedEx Express has added capabilities in important international markets that have given us more robust transportation networks. Now, combined with some of the things I was reading earlier, what they mean by robust is first, this just straight up increases sales because it's new territory where deliveries can happen. But also, it gives you new sales in all the previous countries you were in. And that's what they mean by robust. And that's why they think they're such a growth company. That what FedEx has noticed over the years is that every time they add a new country or a new area or they expand their network, they increase sales everywhere. As their existing network is already very large, as it is right now, they claim it's the largest in the world. And now they have about 200 countries. The cost of adding the 203rd country is not as scary as it used to be, not at all. But it still increases sales more than ever because now they're increasing sales in 200 countries when they add the 201st country or whatever it is. The completion of the physical network integration in 2022 and consolidation of flights into our Paris hub has allowed to significantly improve operational efficiency in the Central European road hubs. And overall, they're talking about an intra-European service as well. This Paris hub, which is a relatively new investment for them, is about the same size as it would have been way back in the day. They don't have to have a fancier hub necessarily than they did 20 years ago. But the effect is to impact the Netherlands and Italy specifically, but also all of Central Europe and also anyone outside of Europe going into Europe. That's what the intra-European service means. That is a lot of benefit for a hub that arguably is just a little bit updated compared to the hubs they would have had to build 10, 20 years ago. Usually you find companies slow their growth as they get larger. A lot of paragraphs trying to explain to potential investors that in their business, for maybe they didn't expect it, maybe they did, but it's the opposite of the norm. As they've gotten larger, their growth is accelerating. At least that's what they think. Hey, if you're getting more comfortable uncovering the stories behind the numbers, please like and subscribe. Fuel supplies and costs. What they're explaining is that this is what most of the management and most of the value they can create for investors is in keeping this fuel supplies and costs under control. The cost for jet fuel, in particular jet fuel getting to that new Paris hub, is right now looking a little bit off trend. We can see from 2019 to 2023, jet fuel costs as a percentage of revenue was hovering around 3-4. Since the Paris hub was put online in 2022, it has increased to higher than it had been in this whole time range. It's actually made it up to 5, which is not crazy bad. But what they're saying here is that they spend almost 2 billion extra a year in jet fuel costs compared to before the Paris hub and a couple of Asian hubs, compared to the most recent expansion into new hubs. This is not likely to go down. Now that those hubs are open, these costs are probably going to continue to increase as they hopefully use those hubs more and more. That's how to think about this. But the percentage of consolidated revenue should hopefully go back to be in line. And so this will not improve technically, but it won't stay worse, which right now it's slightly worse. It's been from 3 to 4-ish% to now it's at 5%. They're hoping it will decrease to about 3 to 4% again. The revenue part of the equation will be how you get there. And so revenue, they do think will increase to the point of getting this to be low again. And this is the number they're specifically calling out as the most important, because you could put almost any of the costs and divide it by revenue and do this kind of percentage analysis. This is FedEx themselves pointing to jet fuel cost is probably the most meaningful cost to think about when thinking about the revenues we're targeting. As they grow, it seems like they have more opportunities to keep growing. Very not usual, to be honest. Despite all this growth that they're talking about everywhere, revenue actually objectively went down in the last year. The closest thing I've seen to an explanation of that is a seasonality section, which is actually just essentially a link to check out item 7. And so that's what we're going to do. I'm going to stop looking at the item 1 and I'm going to follow this lead up to the item 7 management's discussion and analysis. Now remember that the item 7 is often prepared by the CEO's office, by managers, and it's the more kind of extroverted people in the company, the more business type people. Okay, here we made it. Our operating results for 2023 were negatively affected by macroeconomic conditions, including inflation well above historical levels and elevated global interest rates. For them, they had to reduce flight hours, temporarily park and even temporarily retire aircraft, and canceled network capacity projects. Particularly in the first half of 2023, volume went down. And so revenue decrease can be explained by the fact that in response to what, from their perspective, was a surprise in inflation, they reacted quickly, played it safe, and just took the L, basically. They willingly reduced their revenue once they realized that they probably didn't have the right expectations about what their costs were going to be for 2023. They decided to play it safe and accept less business. Ooh, they included a fancy chart, which I love, but I should have shown this chart rather than just reading the paragraph, because obviously if there's a chart, that's a better way to look at it. This explains it. FedEx Express is the first two charts. All the other charts are smaller parts of their business. And here is the average daily package volume. And you can see it decreased in the US domestic, which is their domestic country where they're started and everything. And so they have the most business. But in the international, it actually dropped from here to here. Now, what's interesting is in this year, 2022, they opened several new international hubs. The default expectation a year after opening a couple pretty big hubs, including that Paris hub and some Asian hubs, is that this was going to increase just because there's brand new business coming from those hubs. The fact that this didn't even maintain itself after opening new hubs is a lot worse than this. And so even though when you look at the charts like here, it looks like, oh, most of the decrease in revenue is coming from US domestic. Yes, there is some decrease here. Like this is a real decrease, but this is not the big deal. This actually is fine. Like it doesn't even matter that much in the grand scheme of things. What's more concerning about the revenue is that this did not increase revenue a full year after opening up brand new hubs, pretty big deal hubs as well. What we should be keeping a closer eye on is this international FedEx Express daily package volume. We should not be happy if this continues. What we want to see is a bounce back as soon as possible. Their only justification is inflation surprised them, so they haven't used these hubs to full capacity. They're a little worried about what inflation is actually going to look like for them. Hopefully, they figure that out quickly, because every month that they spend not using these new facilities because of a lack of preparation on their part is frankly what it is. The costs of these new facilities are not leading to increased business activity, increased value. Not a terrible, terrible deal. They have many, many international hubs already. And so they know what they're doing when it comes to managing this business, of course. But genuine slip up here. I mean, the only way to describe this is a slip up on their part. They themselves, shortly after in the item 7, this business optimization and realignment costs, saying, we did slip up. We know we slipped up. We slipped up kind of bad, and there are going to be realignment costs in order to get back on track. In the second quarter of 2023, we announced our plan to fix this mistake. It's called Drive, all caps. This is their solution to the slip up that we just described. Just shutting down your capacity because you don't know what's going to happen is not acceptable. And Drive is the solution to make sure that people start using all the facilities again within FedEx, even if it's a bit uncertain times in terms of costs and all this other stuff. So I don't think it's the worst thing for FedEx to make mistakes. It's understandable that it caught them by surprise. I mean, certainly since 2020, it's been uncharted territory for a lot of big companies. It's not crazy that they would have slipped up, but this slip up was big. It's up to you, really, and individuals' preference, whether this is something that makes them uncomfortable or not. Personally, I don't think it's a big deal to have a slip up if you're already correcting it. I would be more concerned if there weren't an emphasis on recognizing and correcting the mistake on the annual report. But what we've seen here is that they are emphasizing the correction. But some people would say, why would I invest in a company that makes a slip up when there are many other large successful businesses out there that aren't making big mistakes? And that's very fair. I mean, it is a competitive market. And that's the problem with making a mistake is so many companies haven't made mistakes yet. Doesn't look the best ever. An interesting setup to the valuation reveal. What we have here is a very good company growing. It's got some unique things that make it an attractive investment, but there were mistakes made. There were arguably some mistakes during the pandemic. There were some big mistakes in the year 2022 and so far in 2023. How do you think about this in terms of it's a good company, it's making mistakes though at a large scale, and it's correcting those mistakes and identifying those mistakes? We can be helped out by our Sage Seeds AI, which is going to suggest a valuation ranking according to the current price. It's not investment advice, but it does take into account the current price. Please don't forget to like, subscribe, comment about this business, about your understanding how do these delivery companies work or how they think about themselves. Do you know other delivery companies? All of us, pretty much at this point, are used to getting deliveries from the internet. What do you think about it? Please share your wisdom. Share this video. FDX is ranked 3 out of 5 in value for the 2023 season. Now, smack dab in the middle of what is so far early stages in the season. 3 is the sort of position where you could easily see it getting lost in the ranking as more companies are being added. And that's kind of how I'm feeling as an individual after going through this report as well. Good business, but the execution is kind of getting it lost in all the other alternatives out there. Simple businesses are good businesses.